In 2026, financialization has reached a point where the financial sector, including banks, hedge funds, private equity, shadow banking, and derivatives, is no longer serving the real economy, but instead growing larger and more powerful than it. In the past, the role of finance was to support businesses, facilitate growth, and drive innovation. Now, the real economy exists primarily to serve finance, creating a situation where financial gains are prioritized over tangible economic development. The numbers behind financialization. The most glaring sign of this shift is the immense power of the financial sector. In 2026, the financial industry captures the largest share of corporate profits in history, often accounting for over 40% of all U.S. corporate profits. In contrast, real business investment, the kind that builds factories, develops new equipment, and funds research and development, R&D, has sharply declined. It's fallen from around 5.2% of GDP in the 1960s and 1970s to about 2.9% in recent decades. Moreover, non-financial corporate debt has hit record highs, but instead of funding productive investment or innovation, much of this debt is funneled into stock buybacks, dividends, and executive compensation. This financial engineering is one of the primary drivers of stock market gains in 2026. However, it's not real earnings growth. It's a speculative bubble fueled by debt, share repurchases, and hype. How financialization destroys the real economy. Short-term focus. Companies are increasingly obsessed with short-term profits, focusing on quarterly earnings and stock prices rather than building long-term value. This leads to cutbacks in R&D, poorer product quality, and workers being squeezed for profits that don't translate into their own wages or job security. Stagnating wages and skyrocketing executive pay. Wages for most workers have stagnated, while executive compensation and shareholder returns have exploded. The CEO-to-worker pay ratio has surged to more than 300 to 1, highlighting the ever-growing disparity between those at the top and those at the bottom. Essential services as speculative assets. Housing, healthcare, education, and childcare, once essential human needs, have become speculative assets for Wall Street investors. As a result, rent prices soar, medical debt explodes, and student loans become lifelong burdens for many Americans. These necessary services are now treated like commodities to be bought, sold, and profited from, rather than as basic human rights. Shadow banking's hidden risk. The rise of shadow banking, non-bank lenders, fintech, and hedge funds adds hidden leverage and risk to the economy. These institutions aren't subject to the same regulations as traditional banks, which means they can operate with much higher risk levels. When these institutions fail, taxpayers are often left to bail out the system, risking another 2008-style crash. Speculative tech bubbles. The massive influx of capital into speculative AI stocks in 2026 is a textbook example of financialization's impact. Trillions of dollars are poured into speculative technology stocks, creating hype bubbles that drive stock prices up without any real increase in productivity. Meanwhile, actual innovation and productivity growth remain sluggish, and real-world applications of new technology stagnate. The human and societal costs. The consequences of financialization are catastrophic for everyday people and communities. Middle class crushed. As the cost of living for essentials like housing, healthcare, and education becomes increasingly out of reach, the middle class is squeezed, with fewer opportunities to build wealth or climb the economic ladder. Inequality soars. The wealthiest 1% have captured almost all of the income growth in recent years, while the majority of the population has seen wages stagnate or decline. The gap between the ultra-wealthy and everyone else has never been wider. Stifled innovation. As companies hoard cash, spend money on stock buybacks, or pay off shareholders, there's little incentive to invest in new technology or workers. R&D budgets shrink, and long-term planning takes a backseat to short-term profit. Communities hollowed out. Entire towns lose their major employers as companies are sold off or closed in the name of profit. This leads to job losses, school closures, and the death of local businesses. As finance drains value from the real economy, communities suffer. This isn't free market capitalism. What we're seeing in 2026 is not free market capitalism gone wild. It's a rigged system. Finance has rewritten the rules in its own favor through tax loopholes, lobbying for deregulation, and bailouts when things go wrong. Meanwhile, regular people on Main Street pay the price, losing jobs, falling into debt, and watching their communities deteriorate. What you can do in 2026. The good news is that you don't have to be passive in the face of this financial onslaught. Here's what you can do. Invest outside the Wall Street casino. Whenever